The following segment is sponsored by Daniel A. White and Associates. It does not necessarily reflect the views of WDEL or Forever Media. Rick Jensen on 1150 AM, 1017 FM, WDEL.
All right, before the commercial break and the news, I said I would share with you a little bit of detail here on the Delaware property tax reassessment that it may not just be one and done. Oh, no. There's more coming. But first, let's get to my good friend Dan White. I'm a very, very happy client of Dan White for many, many years, specializing in retirement income. You can always reach him, Dan White and Associates. Give him a call, 888-690-8820. Hey, Dan, how you doing, buddy?
Good, Rick. How about yourself?
Good. So I've been so slammed here, I didn't even get a chance to look at our email. That's just honest. So, but I imagine it's something that has to do with making sure we don't lose any of our money.
Yeah, it was kind of interesting. I went back. I wasn't sure what to talk about today, so I went back, and obviously the banks are in the news a lot. And I listened to last week, and Dan Simon was on, and he had touched a little bit on Silicon Valley Bank, and I thought I would just kind of piggyback on that because we have gotten some calls from clients in the last week or two about how safe their money is. And I wanted to explain to people what an M as in Mary, V as in Victor, A as in Al, MVA is, and why I think insurance companies are a little safer than banks.
Okay.
Yeah. So what an MVA is, it's kind of interesting. Dan might have touched on this a little bit, but one reason insurance companies are safer, if I gave M&T Bank $100,000, they take my $100,000 and they, as Dan mentioned last week, they go invest it in, let's say, longer-term treasuries. Let's say they bought 10-year treasuries. And now interest rates in the past year have hiked up, and if they had to liquidate those treasuries, they would take a loss on them. Well, I can go in the bank whenever I want and say, hey, give me my $100,000 back. And if enough people do that, I mean, that's kind of the problem. That Silicon Valley would have been fine if everybody didn't ask for their money all at once. You know, they wouldn't have had to liquidate anything. But since everybody was cashing out at the same time, that's where they ran into problems.
Yeah.
With insurance companies, as we well know, when you buy an annuity from an insurance company, there are what they call, there's no charges to get in. In fact, a lot of times they'll give you a bonus to get in, but they have what they call back-end surrender charges. So if you bought a 10-year contract and you want it out in the third year, you might have to pay 7 or 8% of your value to get out of the contract. So that's one reason they're safer. If they have to break a long-term investment, it's not going to be on them. They're going to pass that cost on to you.
Fair enough.
And then the other thing that comes into play, most contracts today, again, in order to prevent a run on the insurance company, they have what is called MVAs, and they stand for market value adjustments, and they're just for exactly this circumstance. Say you bought an annuity contract 2 years ago and interest rates were really bad. Maybe you got in at 1%, and now rates have skyrocketed, and now you can get in that same annuity for 5%. So you're thinking to yourself, what am I doing in this 1% contract? I'd rather go out and take my money and go buy a 5. Well, the market value adjustment says if you want to do that, if interest rates worked in your against you, they're going to hit you with an additional penalty in addition to the surrender charge for you to get out of the contract. So that protects the insurance company from a run on the company. Now, let's turn that situation around. Say you got in today at a 5% interest rate, and let's say we have some financial crisis and the Fed drops rates all the way down to 1% again. You still have that surrender charge, but the market value adjustment would work in your favor. In other words, the insurance company would say, we'd like to get this 5% off the books, and rather put them in a 1%. So they will actually, in a lot of cases, waive the entire surrender charge. That market value adjustment may make up, and sometimes they'll pay you more to leave.
Wow. That's amazing. Yeah.
Yeah, so it works both ways. It protects the insurance company when rates are climbing as they are today, but it protects the consumer when rates are falling. So in my opinion, I think insurance companies are a heck of a lot safer than the banks because, like I said, they have these built-in mechanisms, surrender charges, and market value adjustments that really prevent a run on the insurance company so they don't have to break these longer-term investments.
I talked with two people who worked for really, really big banks, and we were talking about this and how much you're guaranteed, what, $250,000, stuff like that.
Yep.
And each one of them said, well, here's something people don't know. When that happens, you think, okay, you can get your $250,000. You said, no. It can actually take years to get that money. You'll get it.
Oh, absolutely.
But it can take years. So when when an insurance company, let's say they make mistakes. I know of an insurance company out of, I think, Virginia that overexposed themselves in disability insurance. They oversold it, basically, and they had a lot of claims. And so they went into what's called receivership. There was another one out of, I think it was in Charlotte, North Carolina, I believe. And they were Kentucky. Oh, my gosh, yeah, the one in Kentucky. They were involved in junk bonds. And so they pretty much went under. They go into receivership. Another company is going to take them out. And I noticed that people are actually able to get their money. It seems a little bit faster. Have you ever experienced that, and how long did it take for people to get their money if you did?
Yeah, it's kind of interesting. The two biggest insurance company failures that I've heard of in my career in 35 years, one was Mutual Benefit, a big company down south, and then you had back in the 80s Executive Benefit Life out in California. And you hit the nail on the head, Rick. They go into receivership. A lot of times what they do, they try to find a buyer for that insurance company because there's still some good assets on the books. But even while that's in play, while they're looking for a buyer, and the same thing happened with Silicon Valley. They were looking for a buyer, but this thing happened so stinking fast. I mean, there was no time.
Yeah.
But what happens is, I mean, with the insurance companies, let's say it's life insurance, they're still paying claims. They're still processing loans and withdrawals, that kind of thing. So, yeah, they're still operating. Even though they're under receivership, because, again, basically what's happening is another company, they're taking over that company and trying to restructure debts and liabilities and that type of thing. But worst case, they're still going to pay death claims and that kind of thing. If you're just looking at withdrawals, it could take a little while, like you say, until they sort everything out.
Yeah, well,
those are insured, just like FDIC. You have the state guarantee associations in every state that usually guarantee very close to the 250. It could be 250, could be 300 per state per the State Guarantee Association.
Yeah, my opinion, for what it's worth, is that as fragile as the overall design is of our monetary and banking system, that our banking system is good. I mean, we're in good shape. You had these very specific instances, whether they're into cryptocurrencies in New York or whether it's this very specific tech Silicon Investor Bank out there in Silicon Valley. I think overall, like, I got money in Wells Fargo. I think they're fine. WSFS, I think they're fine. Yeah. These are not the specialized banks that bring concern. I think the concern of the Treasury is twofold. Janet Yellen, in my opinion, does not come off as somebody who's trustworthy when she speaks. And, well, it's true. And she's had a history of misspeaking and saying things that are not true, and probably be better if they said it's time to retire and hire somebody else. And the other is that, I've always believed we went back to the gold standard would be a lot stronger anyway. But our banks aren't into crypto, and they're not very specific when it comes to any one particular type of investment. So, yeah, I have confidence in the banks here.
I would agree with you. I would agree with you to a certain respect. But you know what? What happened to Silicon Valley could happen anywhere. And the bottom line is this. If everybody that had a dollar at that bank asked for, so say Wells Fargo, for example, if every one of Wells Fargo depositors today said, hey, I want all my money, they would have problems too.
Well,
so
sure they would.
The whole system is predicated on, hey, not everybody's going to take their money out all at once.
And that is the big concern of the Treasury and the Fed. They're worried that people might actually have this emotional reaction. And let me say this.
Bank panic.
Yeah, and I would say the irrational emotional reaction, which we don't need to have. The bank's fine here.
Yes.
But you're right. If everybody just said that they're just going to take all their money out. And by the way,
the other
go ahead.
The other major difference between now and, let's say, the Great Depression and all that kind of thing, back then you had to physically go to the bank to remove your money. Now you don't. Now you can sit in your office and you can click something on your computer and, boom, you transfer $1 million out of your bank account. That's what happened out in Silicon Valley.
Yeah, but where are they sending it to?
No, they might be sending it to, they probably had it linked to other banks and that type of thing, and somebody got wind and said, hey, your bank's in trouble.
Yeah.
Get all your money out of the bank. These guys are sitting in their office clicking buttons, and poof, $42 billion goes out of Silicon Valley Bank.
And by the way, that's the key right there. They had to click it to another bank.
Another bank,
yeah.
Exactly.
All right, Dan White. Oh, man, I always love your advice. You know that. I've taken your advice more times than not. Okay, I'm imperfect. I don't always take your advice, but more times than not. Sunday morning, 7 o'clock, on the money. What's the topic?
Appropriate enough. We're talking about our banks today.
Very good. But more in depth. So, a cup of coffee in the morning on Sunday, 7 a.m. on 1150 a.m., 1017 FM. You can listen to the stream at WDEL.com. Dan White, give him a call, 888-690-8820. I did. I'm glad I did, and you should too. How do you like that? There you go.
Go Phils.
Go Phils. Take that. All right, take care. 302-529-1017. I want to get to John Marino